Hi everyone, I'm Jeremy Reynolds, and now I'm looking forward to sharing with you another daily money tip for you. I've been talking the last few sessions about savings considerations when you're looking at purchasing a property, and I've been particularly talking to those who are first home buyers because I can assume that you haven't had the experience before, therefore knowing what you need to be saving and having a plan for those savings is absolutely crucial. So I've talked about making what it means and of a percentage of what you should be saving, and how the constant question that gets brought up, or the overt statement, say 5 to 10% of the purchase price, which is actually wrong. It should be actually a percentage of the total loan requested. That means a percentage involving the amount for purchase, including all fees and charges. Now, I did consider and I did talk about stamp duty in previous sessions, but today I'm going to talk about lender's mortgage insurance. So for the commentary on the subject, when people say, you need to have, I'll use the figure 10% saving of the purchase price. If you're having 10%, it leaves, which is the remainder, means you're going to be borrowing 90, right? Which means that your loan has a LVR, a loan to value ratio, of at least 90. And I say at least because we've actually got to say that's including stamp duty, fees and charges, which means it's deemed by the banks a high risk loan. In an ideal world, you'd be borrowing 80% or less. Ideal world doesn't really exist. It could be advantageous for you to enter the market. It could be quite difficult for you to get that savings to be able to borrow that amount. So we need to consider the fact of this. If you borrow over 80%, so in other words, over 80% of the value of the property, we call this LVR, or loan to value ratio, most typically banks will add what's called lender's mortgage insurance to your loan. Now, this is insurance that is not for you. It does not cover you. It does not protect you. It doesn't offer you any level of cover. This is actually designed to cover the bank or financial institution's risk, meaning that because you're a high risk loan for borrowing more money, it doesn't mean it's a personal reflection, it purely means you're borrowing more money. More money you borrow compared to the value of the property is a higher risk. So they manage that risk or mitigate that risk as much as possible by actually making you, as the borrower, or take out a level of insurance called lender's mortgage insurance. Now, the greater the LVR, so it depends on the bank's policy how high LVR they go up to, but typically, let's say the maximums are 90, some 95. Well, the higher it gets, the more lender's mortgage insurance will be included. So how is this calculated? All right, so it is based on, let's say, the value of the property. So there's different bandwidths, so up to 300,000, 301 to 500, and so on, all the way up to potentially, say, a million. Plus, it's calculated utilising a percentage. So closer to 80%, the lower percentage of it that will be taken into consideration. Okay, so typically speaking, an 81% loan, so only 81. So if you're on that lower level, consider borrowing less to void yourself of lender's mortgage insurance, get the property for just that smidgen less, because you'd be looking at, on let's say a $350,000 loan, or to 500, you'd be looking at 0.568% of the value of that property. Okay, so you'd be looking considerable amount of money. Now, if you start to borrow in the higher amounts, which most first home buyers are actually looking at, they might not have that substantial savings. This can be really high. The percentages can go extremely high, all the way up to say 3.3% for the same value property, but given that you're borrowing over 94%. The next consideration is, with a different bank and working with an alpha finance consultant, is working out whether that lender's mortgage insurance can be capitalised. So again, I'm going to apologise for using a big word, but I'm going to explain what it is. Capitalised means, can that fee, that insurance, that lender's mortgage insurance, be included in the loan or what you're borrowing? Now, typically that depends. If you're getting even 85% lend, banks will most often say, yes, you can include that. When we start to get to the 90-95 lend, there's some other considerations. So they might say, the bank, and there's a lot of different banks with different policies. So let's say there's no other risks other than the LVR at this stage. So the property, the security is in a good location, your personal risk, let's look at you, you've got a good borrowing history, no credit risks, these sort of things. It's just that you're borrowing a larger percentage in the 90 percentile. So if we're looking at this, so they may typically say, yep, you can borrow, or you can include that lender's mortgage insurance in the loan, and they might say up to 95%, which means that typically it might be a 92-93% LVR, and then including on there, which means including the lender's mortgage insurance, the loan cannot go above 95. Some other lenders will actually say 90, including LMI, which might make it up to a 92-93% lend, depending on those brackets, and how much the property's actually worth. But what I'd like to suggest to you, that the goal should always be to borrow as little as possible to achieve your goal. So if this means getting a more suitable property in your budget so you can get closer or below the 80% LVR, whether it means that you actually borrow a lesser property, or what if I always like to consider, if you're on that borderline, you've just gone over your 81 to 82% lend now, you're going to pay lender's mortgage insurance. You can't get out of it. So what I'd suggest, if it's that close, there's a margin there for you. The margin being that you should really be looking at offering that property and trying to make offers that get you below the 80. Again, if you're closer to the 90 anyway, the offer isn't going to necessarily void you of paying lender's mortgage insurance, but what it will do is make sure that you pay less mortgage insurance on your loan overall, which means that you can then pay off your loan sooner, you can contribute more to the principal, rather than purely paying off fees and charges over the long term. Now, I'm Jeremy Reynolds. I look forward to teaching you more about this and helping you in the long term to achieve your goals by having the right budget in place, by preparing you as early as possible and helping you tackle all of your money problems. And again, I'm Jeremy Reynolds and I'm here to help. And please subscribe to the Jeremy Reynolds Money Coach podcast. Give me a 5-star rating and leave your comments. Thank you. Have a fantastic day.